Thank you all for joining another AmTrust Title webinar series on commercial real estate loan workouts and restructurings, COVID-19 edition. Webinar is sponsored by Steve Napolitano, Senior Executive Vice President of the AmTrust Title. My name is Dak Sharfstein, and I am a partner at the law firm of Casson & Casson LLP, and I will be moderating the panel today. I would like to introduce the panel members, all of whom need no introduction, but are well-respected industry leaders. First, Anthony Orso, President of Capital Market Strategies for Newmark Knight Frank. Next, Richard Karikian, Head of Non-Recourse Commercial Real Estate Lending Wealth Management for Morgan Stanley. Christopher Heron, Managing Director at Ironhound Management Company. James Bizomo, Senior Vice President and Chief Underwriting Counsel for AmTrust Title. And finally, my law partner and colleague at Casson & Casson, Rand Pepys. Before we start today with the question and answers, there's a few points that I would like to put into perspective, and I think it's going to really focus on how the discussions are going to move forward today. First is, in our practice, we've been seeing a lot of increased written requests from borrowers to lenders and servicers, at least to enter into pre-negotiation letters in order to restructure and work out their debt. We're seeing this in all asset classes. I think today's focus is more going to be on the hospitality and the retail sectors, only because of the quick and significant decline in cash flows to those asset classes, and that's causing a little ambiguity in how these restructurings and workouts may occur in those asset classes. And finally, uncertainty in the market. In my personal opinion, I think we're going to see 2 or 3 potential modifications and restructurings on any given loan, especially in the asset classes that we're going to be discussing. And I think the panelists today are going to put into perspective how this uncertainty in the market is affecting a lender and borrower and even title companies' abilities to restructure and work out this debt. With that, my first question is to Anthony Orso. Anthony, I know you've been working with borrowers specifically in the hospitality sector. What are you asking lenders and servicers for in these restructurings? I'm assuming they're going to need sufficient time till occupancy comes back in order to work out these loans.
Well, I think just take a quick step back. Unfortunately, when you think about CMBS in particular, the pipes were just not designed for every hotel loan in the United States to be transferred to special servicing at the same time, and that's kind of where we are. So at the end of the day, we're probably doing about $1.5 billion of loan restructurings. Unfortunately, many of the loans that I made back when I was at CCRE have come back, and we're trying to help those borrowers deal with the current situations. And really, I think at the end of the day, most of the hotel deals are going to need new capital. And whether that capital comes from the existing borrowing entity or whether it comes from new investors that are willing to buy the mezz and put up some rescue capital. I mean, because look, you can get a 3-month extension, but in 3 months from now, you're likely to be in the same spot. So with the services, and it's mostly Midland and Wells, some degree Midland, Key Bank, they're answering to all the B buyers, and there's no real answer as to when the market's going to come back. So the only thing I see, if you can't come up with a long-term plan to get capital to your asset, you're going to have a real problem.
And is that I know you work with some complicated capital stacks as well. If there's mezz or subordinate debt, is that making borrowers' ability to restructure these loans easier or harder?
Well, there's a lot of mezz positions, particularly on some standalone securitizations, and certainly ones that I've done in the past. And what happened in the market in CMBS, years ago, was we started cutting off the trust at an investment grade level. So you have a mezzanine position that may have started at 55%, but dealing with a UCC filing and a possible attack from a predatory lender, particularly if the existing group who bought the mezz decided to sell it, that's tough. And we are dealing with those situations. And the truth is, any day they could sell that position and you can find yourself in a fight. Now, we could talk about whether you can actually go forward with a UCC filing. There's some recent examples of maybe you can't, but that's just a short term. In the end, you're going to have to come up with capital. As I said earlier, it's the only way to get out of this.
Chris, what do you see? I know you represent borrowers also, maybe in different different asset classes, but what are you seeing here as well?
Yeah, look, I think you're right to focus on hospitality and retail. It's been the lion's share of the conversations we're having because the cash flow issues are immediate and they've existed now for 60, 90 days. The problem is every time we get on these, or have these discussions, the economy hasn't opened up yet. So the backside of this, what it looks like, as far as everybody returning to work, returning to travel, getting on planes, that hasn't started to happen in any material way just yet. So, we're having these conversations. I agree 100% with Anthony that every restructuring we've done, 11 years of doing it, has required cash from the borrower to get something done. But right now, it still remains a little bit challenging to figure out where to put that cash and not lose it twice. And I think, Dax, to your point too, you could see multiple restructurings take place depending on, you get something in place that works today, and then 2-3 years from now, you have covenants that nobody wanted to address fixing now that you got to then find yourself back at the table to fix when the economy recovers.
Rich, that brings up a good point. I know in your position at Morgan Stanley, how's your portfolio looking, and how is this going to affect future originations on CMBS loans?
Yeah, I think we're fairly pleased with how our borrowers have been responding. There have been some discussions, but overall, I think we're in pretty good shape. Going forward, we're all in the early days of this, and it's a very fluid situation. And that said, like other major CMBS shops, we're back open, if you will, looking to originate new business, albeit with a redefined credit box, looking at scaling back leverage and favoring acquisitions over refis. I think big picture is we're working through it day to day. I mean, we're targeting closing loans end of June, more likely July, sending out term sheets now. So we're cautiously optimistic and looking at new deals through a different prism. That's where we are. But again, it's a fluid situation.
Got it. Thanks, Rich. Anthony, that leads me to a good question for you: is the quicker these restructurings happen, will that create more stability in the market?
Well, it'll create stability in terms of potentially new lenders coming in for some of these hotels and retail properties, but they're likely to be bridge lenders because it's going to take a fairly long time before Morgan Stanleys and others are going to do long-term fixed-rate loans on unstable cash flow. Because remember, you're dealing with lots of hotels who are essentially going to be like opening up a new hotel. You got to build a new book of business. No one knows when business travel is going to happen again. Conference travels, I'm sure we're going to be doing meetings like this maybe for the rest of this year, maybe next year too. So even when hotels open, it's going to be a problem. Same is true for retail. Retail was unfortunately going the wrong way. And, I've heard people say that retail rents are probably down 20 or 25% on average. So again, until those loans get fully stabilized to some degree so that you can think about doing a long-term loan, you're going to be in this prolonged period of essentially modified workouts.
In this, Jim, on the title side, are you seeing large number of requests for modifications?
We're seeing people right now look at it. They're looking for, bring downs, title contends, just to find out what's out there. I think it's a little too soon right now to start modifying loans and seeing modification policies. At the end of the day, if they're going to do it today, it's very expensive, as you know, to buy the title policy. And we may have to do it again in a month or 2 months. So right now, people are just assessing risk. So, to the extent that we can search the public record, they want to know what's out there. We're having trouble right now with, obviously, searching county clerks that closed in New York City. But, we're giving them the best information that's available. I think we'll start seeing loan modifications the next few weeks start rolling in, as we get a little further along and we start to open up. Now people can at least see the light at the end of the tunnel.
And just following up on that, most of these modifications, at least what we're hearing in the marketplace right now, will require future amortization on missed debt service payments, maybe changes to interest rates. With the high cost of getting those modification endorsements in New York, how's that going to affect lender and borrowers' abilities to restructure and work out these loans?
Clearly going to be a factor. Somebody's got to come up and pay for that. To the extent that we're putting new money on, there's mortgage tax involved. Modifying is not cheap. It's very expensive. Therefore, do we do it today and then do it again in 2 months from now or a month from now? Probably not. Right now, people are assessing their risk and trying to find the right time to do it.
Got it. Thank you. Rand, I know that you've been working on a number of these workouts and restructurings and pre-negotiation letters. Just out of curiosity, are you seeing it be a more cooperative process than we've seen in the past between borrowers and lenders?
Yeah, I mean, certainly on the bridge transitional floating rate stuff, I definitely think the lenders and the borrowers are behaving in a very cooperative fashion, and not just cooperative, but sort of rational. I mean, the lenders are not insisting on opportunistic changes at that moment. It's a short-term. A lot of these are short-term solutions, whether it's getting a PPP loan or, obviously some kind of forbearance or moving reserves from one place to another, particularly like on hotels, moving the FF&E reserve to a debt service reserve. And I think the borrowers are being pretty reasonable about what they're asking for. They're not shooting for the moon. I think both parties know they're going to have to, in all likelihood, come back again for a more permanent change to the loan. It's different on the CMBS side. The pooling and servicing agreements and the relationships between the master servicers and the special servicers, it is not built for this situation. They don't or profess not to have a lot of flexibility in what they can do and in what they can do without moving the loan to special servicing, which is a big problem because special servicing is expensive. And it's, at just the time where borrowers are coming in and saying, I need some relief, even if it's only temporary, even if it's, a business that you anticipate will come back 100% when you open up, they need a forbearance, and that pushes the loan into special servicing. And then right away, that's costing them money. So it's difficult. It's, I think since 2008, I think the master servicers and the special servicers have done a lot of work to improve their relationship between each other. And it may be that the legacy of this situation is trying to create a little more flexibility for the special servicers to deal with at least temporary situations.
What you raised also a good point there is, what about the IRS revenue ruling that was recently passed that allowed for short-term modifications not to be a REMIC rule violation, let's call it? How is that affecting borrower and lenders' abilities to work these loans out?
So, I mean, honestly, I think the most valuable point of that is really to help the borrowers. I mean, honestly, I think there have been a lot of times where I've done deals and the lender or the special servicer says, you propose something and they say, well, that might create a REMIC problem. And you're not really sure if that's true or not, but it's a pretty good weapon that lenders sort of use when they don't really want to address the situation or when they're really not sure. And so I think this is really helpful to at least take that off the table, that that's not going to be a REMIC issue. There may be other reasons why they don't want to do it, but it's not going to be that.
Chris, I know that lenders are asking for certain additional covenants, even in pre-negotiation letters before they get to the forbearance agreements from lenders. I know how Anthony feels on this point, but I just want to get your take on how borrowers are going to react to certain additional covenant requirements in loan documents.
I mean, I think there's less of that. Traditionally, there's less of that in a standard lender, in a standard servicing CMBS P&A, right? I mean, what you're doing there is you're essentially just saying, look, everything we talk about is not final until it's inked on paper. You know, releasing everybody from anything leading up to that date. But you know, look, we're talking about unusual circumstances. I actually see covenants being removed, not inserted here, right? If the lender thinks this is an opportunity to clean up a previous mistake, you know, that's much further down the road than the initial conversation stages, right? It's a give and take for everything in the docs, but I mean, take any of these retailers or these hotels, and you know, the retailer has an EBITDA ratio that he's got to hit, and now who knows where sales are going to be, but they're trying to pay you rent. You need to let them pay you rent. Or on the hotel side, they got a debt yield requirement 2 to 3 years from now. Like, you know, I see those things getting relaxed a little bit, or to your point, revisited in a couple of years, because the ability to predict that stuff right now is just not, you know, unless you're making a true bet, you just can't do it. But if you understand how these trusts work and how the CMBS model works and how special servicers look at your proposal to modify a loan, it's much more complicated in calculating NPV and what makes sense to them than just putting on paper and saying, we'll give you this much money, cut the loan here. There's a lot more that goes into it that you have to make sure you understand when you make a proposal to these guys.
Got it. Anthony, I want to get your take on that question as well.
It's a joke. Anyone who is on the lending side, whether it's a special servicer or the master, or in fact the B buyers, if they think this is a good time to get more covenants, it's a joke. It's not going to happen. You got to just follow the money. You need new money to come in, and the new money is going to dictate it, because at the end of the day, if they decide to foreclose and take the assets, they're going to have to sell it. And they're going to sell it wherever the clearing price is. And for hotels, if any of the B buyers out there, and I know all the senior guys, I've sold to every one of the B buyers, if any of those senior guys were so great at, and you can quote me on this, were so great in the hotel business, they'd be buying hotels, not making B buyer decisions on hotels. It's a complicated business. And remember, the big brands are now stuck with payables that they haven't gotten, because all of a sudden one day there was no cash. So all the big brands are sitting there having outlaid money for employee expenses without getting the ability to recoup it. So they're in the workout with you. When you have a Marriott deal or a Hilton deal, they're sitting at the table by proxy, and the proxy for them is the owners. And the last thing that a B buyer wants is to take back a property and lose their franchise agreement, because that's a really bad debt.
Got it. Great. Thank you. Rich, on the lending side, the uncertainty in the market, I know that's affecting new originations. What are you seeing here on this? Are you seeing the uncertainty in the market really affecting Morgan Stanley's ability to get back in?
Well, yeah, I touched upon it earlier. We, along with our other competitors in CMBS world, are anxious to get back in, but to do it wisely. You know, it's we want to put term sheets out there that we can deliver on and make certain that we can fund. And we're targeting July.
Just out of curiosity. Sorry, just out of curiosity, are you requiring additional structure for new originations?
Yes, you know, things ranging from debt service reserves, other reserve accounts. You know, we're sort of governed by our exit, and that's the agencies and investors, and they all want to see this, and it makes a lot of sense. Now, will that change over time? Will that relax? Probably so, as we achieve some level of stabilization. When that is a question mark for everyone.
Rich, how are you looking at collections? Like, how do you underwrite a loan, you know, with collections where they are right now? I mean, that to me, I don't know how you close a loan without it.
Well, certainly you're going to be eyeballing collections from the time you sign an app all the way through closing. So you're not just spot checking it once when you fund. So you want to make sure that you know, you have a couple times to. If it takes 60 days to close a loan, you're going to get a couple looks at how that's going. certain tenants you feel better about in terms of your ability to collect than others. So that's going to go into your credit decision-making process. You're going to look at the history before you close the loan in terms of, right now in the past couple months and how those tenants have fared. And then it's a little bit of an educated guess as to, their tenants' wherewithal to continue making payments, doing a deeper dive into their local business or their business at large, taking a look at their balance sheet, what sort of cash they have on hand. So a little bit sharper pencil, I think everyone's going to use when it comes to evaluating the tenant's credit worthiness and their business. How does their business fit into the new world, right? So it's definitely it puts due diligence in capital letters, right?
So all office and multi basically is what it is at the moment.
Well, look, I think there's some sound retail, right? They're definitely shades of gray, but certainly hotels are a non-starter at the moment, and probably for a while. But that'll change. We've lived through this before, maybe in a different manner, but we're always amazed at some point how short people's memories are, right? And we'll get through it. The question is it a 3-6 month, or is it a 1 year or a 2 year? As I said, we're in such early innings of this thing. It's yet to be seen, but I think we're cautiously optimistic about moving forward. Like I said, we're out there signing up deals, but the box is definitely tighter right now. The strike zone is tighter.
And Rand, just moving back on what you're seeing in pre-negotiation letters and forbearance agreements, I know Anthony and Chris's position on that, but what are you seeing in those documents now?
What the thing that's been interesting is that in all the past recessions or disruptions, P&Ls were just, like Chris said, they were really just whatever we're talking about, it's not admissible, and we're not bound to it, love and kisses, let's move on to negotiating. This time has been a little bit different so far because of the speed with which this has happened and the faucet just being turned off everywhere, that there are some things that are time sensitive enough that there are actually some substantive provisions going into some P&Ls simply because it's the first document that they're dealing with. So, one big one is approving stimulus loans that would otherwise violate the prohibitions against additional indebtedness. That may be going into a P&L because there just isn't time for them to wait to go through the whole negotiation on the modification. And another thing we're seeing is cash, either, as a condition of signing the P&L, putting more money into a debt service reserve or moving money from one reserve into another. They aren't gigantic substantive things that are happening in the P&L, but it's a lot more than I ever saw before. And it's just a function of urgency, I think.
Yeah, I would say that. One of the things we always say is, if your behavior on how you negotiate a P&L is any indication of how you're going to negotiate loan documents, if you send back a marked up, ripped to shreds P&L, nobody's going to want to do a mod with you whatsoever. So, but to Rand's point, I would never let any of our guys sign something that, moves money around in a P&A. That's why you're signing the P&A, is to have that conversation. So it goes both ways a little bit, but the message is generally get that thing signed as quickly as you can and don't make it a big issue. That's the attitude.
Agreed. Although honestly, Chris, a lot of times those are the request is coming from the borrower. The borrower is saying, I don't have time to negotiate all this.
I'm just saying the borrower shouldn't be putting those sort of conditions into a P&L, right? You should be getting that thing signed, get to an actual position where you can have a conversation, and don't waste time trying to get these things done before the negotiation ever starts. That's our approach.
I do
But,
agree with
Chris,
you, but wait, hold on one second, Dax. But honestly, things aren't moving that quickly, especially when you're dealing with the special servicers. I mean, they're dealing with thousands and thousands and thousands of requests. And so, particularly with the stimulus fund stuff, there just isn't the time, in some instances. So I hear what you're saying. I agree with you. I mean, that's why it surprised me a lot that borrowers were asking for it and that some lenders were entertaining it.
Chris and Anthony, both of you on this point, is that even if lenders are not getting those additional cash flow protections in pre-negotiation letters, are borrowers willing to forego those positions when we get to the actual forbearance?
I think it depends on what do you mean a forbearance. 3 months? Sure. At the end of 3 months, nothing's probably going to change. So the biggest thing we tell borrowers is you need a long-term plan, and a long-term plan that assumes your hotel is going to be shut for a considerable amount of time. Your group business is going to be down for at least a year. I mean, I've seen reports that say we're not going to get back for 3 or 4 years on the hotel side. So if that's the case, arguing about something over 3 months, it's entertaining. And if you have Rand on your side, you could be even more entertaining, but it's just not going to be that effective in getting to where you want to go. Because if there's real equity in the deal, right, and you're staring down a potential foreclosure at the senior level and with a mezz group, okay, arguing over stuff over 3 months, that's just a waste of time in our opinion. So you need a real thoughtful plan. And I think that's what the services, particularly the special services, what we're seeing is kind of a special servicing light. I want the master to go to the special, particularly when they're the same group, and in a lot of cases they are, and give us a preview of what the thought's going to be. And if you have to call the B buyer, do it, right? And yes, there's a lot of requests being made. There's $100 billion of problems out there. There's over 3,000 borrowers that have issues. I understand the pipes weren't designed for it, but you need to get us direction because that helps provide the right plan in the long run.
And I think, Rand, I was just going to say, Rand, there is a big difference between, as Anthony said, short-term versus long-term, right? If you're checking into the hospital, you're checking into the hospital. Get the thing signed and figure it out, because odds are you're not coming out of pocket to support this thing for that 90 days or whatever we're talking about. But if you are, that's a more short-term type of conversation. That P&A may be the only thing you guys sign. I understand what you're saying, but part of that is why you hire someone or get people involved that know what they're doing and can get the people on the phone to avoid the 3-week backup because you can't get a line in a P&A approved, right?
I agree with you. I'm not an over negotiator of P&Ls, believe me. I think there should be one standard form and everybody should just sign it and move on. I think that
Never let that happen.
Right. Just, Jim, on the title side, everyone's talking about entering into quick restructurings and workouts on these loans. How are title companies looking at searches and lien searches and recording office closures? How is that affecting lender and borrowers' abilities to restructure their debt?
So right now we can't search the county clerk, so we can't get mechanics liens, which tend to be a problem. So we're asking a lot of questions. We want to know what's going on the property. Maybe in years past, we didn't delve as deep, but now we really need to know. If you're not making your debt service and you're doing construction on the property, it's a very good chance you're not paying your mechanics. And there could be these liens out there that have yet to post. So what we think is happening is the county clerk is taking liens into a Dropbox and they're stamping them as received, but they're not posting them, so we can't scrape for them. We can't find them and insure over them. So that brings us to some form of a credit analysis that we may not have done in the past, where we're looking for, some form of indemnity from a creditworthy entity, that in the event there are mechanics liens out there, that they'll make good on them. Other than that, we're able to record, which is a good thing. So we can get our mortgages of record, our modifications of record. The county clerks sort of views that as a money center, because putting on mortgages creates mortgage tax money. The problem is just with the building loans. We can't create new building loans, so we're not seeing much of that. We're seeing some pent-up demand. I mean, there's a lot of them out there, and people are chomping at the bit to get back to work and get these loans closed. But on a modification, just those that are in progress, we're having some trouble getting building loan contins out there, date down endorsements for the building loans, because if we can't search all the underwriters, a lot of these transactions, we're doing co-insurance. So we may have a piece, somebody else has a piece, a third has a piece. We have to all get together and we have to agree to issue that endorsement. And every underwriter has a different way that they want to look at it. This one wants to focus on credit. This one wants to focus on the terms of the indemnity. And it's hard to coordinate, but at the end of the day, we're getting it done, and the projects are moving along at a snail's pace, but they're moving along.
In order to get these mod endorsements in place, are you requiring indemnities? What are you requiring for borrowers to get this stuff done?
So the mod, as you refer to a mod endorsement, a modification in New York is just the title policy with no new money. So it's either in the same amount or the reduced amount to the last insured loan. We're running it just like a regular title. We are asking for indemnities because we can't scrape for mechanics liens. If there's work done on the property, we could potentially be looking for, data from the GC, what kind of work's being done. Can we get lien waivers? Anything we can get to mitigate our risk to cover that little black hole at the county clerk. Now, we are hearing rumors that maybe there's some movement there, and they'll start accepting building loan agreements and start posting mechanics liens for us to search. That'll be good. That'll really help the process move along fast.
Thank you, Jim. One other question to Anthony. Anthony, on these hospitality assets, if quick restructurings can't get done, I assume we're going to see a big increase in hospitality foreclosures. If that occurs,
I don't know if there'll be foreclosures, because I think what's likely to happen is debt may be sold at discounts, and it may be a new restructuring or one that takes into account a bigger percentage of the hotel. Because again, when you foreclose on these hotels, these are operating businesses, you're just setting the clock back to zero, right? So we spent 12 months with a borrower trying to get the asset back up and running, assuming it was a good borrower, and you want to go back to zero. So I'm not sure there's going to be as much foreclosures as there might otherwise be, because I do think at the end of the day, the people who own the B pieces in conduit deals and people who own the controlling bonds in standalone deals are going to be thoughtful, and they're more likely to sell their position than deal with it. And and again, in the past, borrowers can raise capital, buy notes at discounts, and kind of reset their loan basis. I think that's more likely to happen than just wholesale foreclosures, which again, the system is not ready to deal with.
I think too, it's important. I was just going to say there's inherently less leverage in the system this go round than there was last go round, and the over leverage last round caused a lot of the, everybody talked about rescue capital and coming in and recapping deals, but very often it was hard because of how far the pendulum swung inside of the loan balance. So you needed a full scale restructuring. I do think you'll see more instances of guys getting recaps done, which may just allow a loan to get paid off at par, waive prepayment, get it out of the trust, recap it, start over. I think you could see a little bit more of that as a resolution this go round than you did in the previous cycle.
Well, for retail and hospitality assets, is there liquidity in the market to recapitalize those deals? As you guys are saying, no one knows when occupancy is going to come back here. Are people willing to invest in these deals to get them out of trouble?
I don't think today. I mean, not as of May 12th.
Well, there's a lot of capital sitting on the sideline in the private equity world that's looking for 15 to 20% returns. So if you mark the asset down there from its prior marking, there's probably a lot of liquidity. I'm not sure the bid and ask is there yet. So I think it's going to take a lot more time. And, depending on what happens with the economy, things may change. But, remember, we have a health crisis. The last time we had this in 08 and 09, we had a banking crisis. We had financial institutions going bankrupt. So there's money at the banking side, and the private equity guys have all just raised money to deal with this new distress. Question is, where's the pricing at? And I don't think anyone has enough price discovery yet to know that.
Got it. And how is that going to affect borrowers' abilities to get out from under all of this? If they can't get recapitalization dollars and they're having problems potentially working out their loans, the hospitality sector seems to be in pretty bad shape right now. The same thing with retail to a certain extent. Are we just waiting for occupancy to come back, and are we just going to kick the can down the road like we did in 2008?
I mean, in theory, the lender's going to have the same issues, right? As Anthony said before, on the hospitality side, right? You have the brand looking over your shoulder. You have, in a lot of instances, very experienced property owners that know what they're doing. And I don't ever believe the argument that in most cases, the lender can do a better job than the owner of that real estate. So again, once you can figure out where to put that money in and not lose it again, there's liquidity there. But today it's very hard to pinpoint that, right? It's going to take, the economy's got to be open, plain and simple.
Rich,
Yeah, I was going to say. Oh, sorry, Dex. I was just going to say, reiterating what you just said, Chris. I mean, in this instance, so a lender forecloses, they're in the same boat the borrower was in. This isn't, the hotels are not where they are because there's been a management issue. So there's not anything that a foreclosing lender can do that's any different than what the borrower can do. So I think lenders are probably less inclined to foreclose. I agree with Anthony that B piece holders could try and sell, to get something out of it when they might not get anything if they hold on. But I don't see, big sale foreclosures of hotels right now.
Agreed, but the holder of the note at some point is going to want to get paid. I think the question is going to be timing and how long, and maybe Rich, you can add some color on this. How long are lenders going to be willing to wait?
I would say on hotels, it's, like Chris had mentioned, I don't see us in the business of funding them in the near term. I mean, we just they need to have a viable business. Right now they don't, right? I mean, people aren't traveling, people aren't staying. What is it going to look like come this fall, come this winter? So you can't get your hotel financed in the near term. The question is when that tide changes. We just don't know. I mean, we'd love to be able to get there, but I can tell you that now or the foreseeable near future, we don't see us funding hotels.
I mean, there's going to come a point too where like the advances that have to be made by the trusts, right, are going to grow so large, right, across all of these assets that they will ultimately, that spigot will shut off, that light switch will turn off, and they will liquidate those assets because the Wells Fargos and key banks and all the other master servicers are not going to go bankrupt over advances to bondholders that they don't have a high degree of confidence they're going to get the cash back on. So, depending upon how long this drags out, I don't see foreclosure, I see liquidation, but as a result of those cash flow shortfalls that the advances have to be made on by the master servicer.
And just out of curiosity, has any of the pandemic, but the relief funds, the stimulus funds that have been passed by Congress and state regulations, has this been affecting your borrowers, the borrowers that you're dealing with? Has that been going into the determination on how to work out or restructure these loans?
We've had a couple instances where PPP funds come through and there's money in the FF&E reserve, and instead of checking into the hospital as I described it before, the initial steps are let's utilize the interest utilize the funds for interest that we're allowed to use under the PPP, right, and draw down some of the funds in the FF&E for OPEX and principal. And that's, that's a little bit less of a full-scale transfer and more of just a kind of a non-transfer approval by the special. So I do think the application of people who got PPP funds are trying to figure it out. And I think that's going to prolong a little bit of the full-scale, we're screwed, stop making our debt service payments, because they have to utilize that money or else they got to pay it back. So, you're going to push it off a little bit in those instances.
I assume in your dealings with the special servicers that they were okay removing the full recourse and the covenants against permitted indebtedness to allow for the PPP funds?
Yeah, everybody has been, in our experience, has been accommodating as it relates to taking free money, if you will, right? And it's a burden off of their shoulders. So I even if there's a little bit of a glitch, I can't see that glitch not getting fixed. I mean, what judge is going to rule against somebody for taking PPP funds to keep, to do what he's supposed to do? No one. So again, I think I would never make the recommendation. You always got to communicate. But that's a hard one to say somebody did the wrong thing.
Rand, what are you seeing there? On your forbearances, are you seeing lenders requiring their borrowers to go out and get PPP funds, or are they pushing back?
I've seen a few requiring them to go get them. And I've seen a lot of willingness to consent to them and, acknowledge that it's not an event of default and it doesn't trigger non-recourse. I mean, to me, that those funds help everybody, right? I mean, why wouldn't a lender want the borrower to get a pool of money in that will, in all likelihood, be forgiven, and that helps keep the property functioning, some portion of money available for debt service and OpEx. So yeah, I think there's been a lot of acceptability of it, and I know a lot of borrowers that have applied for it.
Absolutely. Anthony, just I know we're running short on time right now, but I want to ask you, in highly complicated capital stacks where you have mezz, how are the mezz treating borrower workouts and restructurings? How is that working with the mezz lenders?
On the hotel deals we're doing, the mezz is treading lightly. And I think the first question you have as a borrower is, if you're not going to pay the senior interest, are you going to make a payment to the mezz holder? Now, I know Rand's going to tell me it doesn't matter. The intercreditor agreement says if you get the money, you got to apply it. I know that because I've written these, and she's written them for me in numerous jobs in the past. However, we're all in a new world. Okay, so the first question is, are you making a payment? Even if the payment is just held in escrow by the mezz, it is a good sign of faith. And what we've seen is the mezz holders, and I don't think it's because they don't think they can perfect their UCC sales now, which I don't really think they can, although you could argue the other side of that. I think what they're saying is they don't want to be in a position to fight with the senior, and they're going to be in the same spot the owner is. And they really, so far, what we've seen is a great receptivity to working collectively with the borrower to try to solve this.
That's great. How are senior lenders reacting to borrower requests with mezz? Are they requiring that the borrower have a plan with the mezz before they even entertain talking to the senior?
In the deals that we've worked on, they've ignored the mezz, which probably they shouldn't, but they've acted like it's not even there.
Got it. And I think that's it, guys. We've come to the end of the webinar. I want to thank you. I want to thank you and all of our panelists today: Anthony Orso, Chris Heron, Rich Karikian, Jim Bizzomo, and Rand Pepis. I would also like to sincerely thank our sponsor, Steve Napolitano of AmTrust Title, and thank you to all of our listeners. Please stay safe, and thank you again.
Thanks, guys.
Thank you, Dex.